I think what I would tell you is that the bigger principle, and we've talked about this a lot, Jason, is that in capitalism, when you over-earn for enough of a time, what happens is competitors decide to try to compete away your earnings. In the absence of a monopoly, the amount of time that you have tends to be small and it shrinks. So in the case of a monopoly, for example, take Google, you can over-earn for decades. And it takes a very, very long time for somebody to try to displace you. We're just starting to see the beginnings of that with things like Perplexity and other services that are chipping away at the Google monopoly. But at some point in time, all of these excess profits are competed away. In the case of Nvidia, what you're now starting to see is them over-earn in a very massive way. So the real question is, who will step up to try to compete away those profits? The old Bezos quote, right? Your margin is my opportunity. And I think we're starting to see, and you've mentioned Grok, who had a super viral moment, I think, this week. But you're starting to see the emergence of a more detailed understanding of what this market actually means. And as a result, who will compete away the inference market? Who will compete away the training market? And the economics of that are just becoming known to now more and more people. I would like to tie it together with Friedberg's point. So at some point, all of this spend has to make money, right? Otherwise, you're going to look really foolish for having spent 20 and 30 and $40 billion. So Nick, if you just go back to the revenue slide of Nvidia, I can try to give you a framing of this, at least the way that I think about it. So if you look at this, like what you're talking about is, look, who is going to spend $22.1 billion? Well, you said it, Jason, it's all a big tech. Why? Because they have that money on the balance sheet sitting idle. But when you spend $22 billion, their investors are going to demand a rate of return on that. And so if you think about what a reasonable rate of return is, call it 30, 40, 50%, and then you factor in, and that's profit, and then you factor in all of the other things that need to support that, that $22 billion of spend needs to generate probably $45 billion of revenue. And so, Jason, the question to your point, and to Friedberg's point, the $64,000 question is, who in this last quarter is going to make $45 billion on that $22 billion of spend? And again, what I would tell you, to be really honest about this, is that what you're seeing is more about big companies muscling people around with their balance sheet and being able to go to Nvidia and say, I will give you committed pre-purchases over the next 3 or 4 quarters, and less about, here is a product that I'm shipping that actually makes money, which I need enormous more compute resources for. It's not the latter. Most of the apps, the overwhelming majority of the apps that we're seeing in AI today, are toy apps that are run as proofs of concept and demos and run in a sandbox. It is not production code. This is not, we've rebuilt the entire autopilot system for the Boeing, and it's now run with agents and bots and all of this training. That's not what's happening. So it is a really important question. Today, the demand is clear. It's the big guys with huge gobs of money. And by the way, Nvidia is super smart to take it because they can now forecast demand for the next 2 or 3 quarters. I think we still need to see the next big thing. And if you look in the past, what the past has showed you, it's the big guys don't really invent the new things that make a ton of money. It's the new guys who, because they don't have a lot of money and they have to be a little bit more industrious, come up with something really authentic and new.
Yeah, constraint makes for great art. Yeah.
We haven't seen that yet. Yeah. So I think the revenue scale will continue for like the next 2 or 3 years, probably, for Nvidia. But the real question is, what is the terminal value? And it's the same thing that Sachs showed in that Cisco slide. People ultimately realized that the value was going to go to other parts of the stack, the application layer. And as more and more money was accrued at the application layer of the internet, less and less revenue multiple and credit was given to Cisco. And that's nothing against Cisco because their revenue continued to compound, right? And they did an incredible job, but the valuation got cut.
In recent weeks, the financial world has been abuzz with startling revelations that have left even the most seasoned investors reeling. Billionaire investor Chamath Palihapitiya a name synonymous with groundbreaking insights and unbiased analysis, has sounded an alarm regarding the hidden risks nestled within the once-trusted bedrock of our portfolios, ETFs. Speaking on X, Palihapitiya's insights have drawn the attention of investors far and wide, both amateur and professional, calling attention to a brewing storm involving the top 10 powerhouses of the S&P 500. From notable tech behemoths like Apple and Microsoft to the venerable financial titans such as Broadcom Inc. and Berkshire Hathaway, these entities wield an almost peerless influence. Is it time to reassess the very fabric of our investment strategies as potential volatility looms on the horizon? Welcome back, everyone, to Investocracy.
Shares of Nvidia are trading lower after reporting a beat for the third quarter. But joining us now is Aswath Damodaran. He is a professor of finance, and he's known as the Dean of Valuation at the NYU Stern School of Business. He is also an Nvidia shareholder. Professor, it's great to have you on. Do you want to get your initial reaction to these results and what it means for the valuation of Nvidia, even as revenue has almost doubled since a year ago?
That's a scary thought, right? I mean, you deliver a 94% growth in revenue, 75% gross margins, 62% operating margin. That's an amazing company. And you lose 4% of your market value. It tells you how much the expectations game on Nvidia has been ramped up. They don't just have to beat analyst estimates. They got to beat them by 10%. And I think investors are also increasingly focused on the guidance that Nvidia is offering. And the negative reaction, I think, is coming from the sobering of that guidance, which is, I think Nvidia is trying to bring investors down for a soft landing, bringing expectations down. But it's going to be painful. Every earnings report, you're going to see more of this phenomenon play out, of them beating the numbers, but still seeing the stock price go down.
In the heart of the financial cosmos, the atmosphere was electric and saturated with tension as Chamath Palihapitiya delivered a compelling exposition against the seemingly unyielding allure of ETFs. His argument laid bare a critical risk that many have overlooked for far too long: the overwhelming clout of the Magnificent Seven and other heavyweight stocks dominating the S&P 500 index. It was on an unassuming Sunday afternoon that his post on X drew an alarmingly vivid mental picture. Envision a small cluster of large-cap companies controlling a staggering 40% of the entire index's market capitalization. This scenario is as if 10 passengers on an airplane have unprecedented command, steering the course of the flight. But before going on with the video, are you into cryptocurrency? If so, check out our second channel, Investocracy Crypto. We bring you breaking news, expert analysis, and the latest trends in the fast-moving world of digital assets. Whether you're a seasoned crypto investor or just curious about the future of finance, we've got something for you. Click the link in the description to subscribe to Investocracy Crypto now. Don't miss out and stay ahead of the game. Now, let's get back to the video.
How much of this phenomenon around Nvidia stock is company-specific with investors versus a reflection of more risk-on appetite in the market, more liquidity coming into the market, and investors just being more excited about big growth stories in general?
It's not an or, it's both. The fact that investors are feeling good about stocks, that equity risk premiums are down, that they feel that they can buy stocks at a higher price is helping. But I think a great deal of this is company specific. I mean, you had $2.2 trillion in market cap over the course of a year. I mean, that's mind blowing in terms of the additional market cap created. I do think, though, that there's a disconnect emerging here between what companies are spending on the architecture of AI, and I think your previous guest mentioned it, and the revenues you're actually generating from AI products and services. And that's going to increasingly come into focus in future quarters.
Supporting this narrative was Kevin Gordon from Charles Schwab, who reinforced this observation with a detailed yet disturbing graphic, evoking the parallel of an airplane's delicate balance that could falter should too many passengers abruptly shift to one side. Joining the discourse, venture capitalist Spencer Hakimian offered a ray of hope with the mention of equal-weight ETFs. However, these financial instruments are not devoid of their own complications. They come with hidden cost burdens, akin to excess baggage fees incurred when traveling, due to rebalancing and tax liabilities. The numbers, often seen as incontrovertible evidence, tell an unvarnished story. The Spider S&P 500 ETF Trust has ascended by an impressive 25.89% this year, in stark contrast to the Invesco S&P 500 Equal Weight ETF's modest 11.94% gain. The information technology sector, while remaining the crown jewel among top constituents, casts a long shadow over the plight of mid-sized enterprises struggling for prominence. The stakes in this financial saga have never been higher, unraveling like a classic suspense thriller that compels even seasoned investors to ponder their next strategic maneuver. But before going any further, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
This reminds me, in a way, of the argument against buying Apple in 2018. Oh, well, there's Samsung out there. Well, how many more people can you sell a phone this expensive? Margins have to eventually come down. But it's up something like 4x, above the high levels of that year. At what point can you, and I mean you specifically, buy a stock like Nvidia after it's been on the run that it's been on, under the idea that it's just so unique it can go much higher still?
No, I think that it is unique. It is in a market where it controls the market. The problem is the market itself might be hitting a stress point, because if you don't get ultimately, Nvidia's revenues are cost to some other company. So those costs have to be covered with products and services that those companies sell. And right now, at least from what I'm hearing from those companies, delivering on AI products and services is turning out to be more difficult than they thought. And that's going to eventually have to show up in them buying fewer chips.
As the curtain eventually drew to a close on this enlightening exploration, the investment community found itself standing at a critical crossroads. The implications of the central message were profound and clear. A nuanced understanding of the depth and ramifications of concentration within the S&P 500 is no longer just a savvy maneuver but a necessity. For those with aspirations of securing long-term gains, embracing the principles of diversification may emerge as the hero of this unfolding drama. The undeniable allure of the Magnificent Seven captivates, yet prudence whispers words of caution, a sentiment akin to realizing that, behind any magnificent skyline, the strength of its foundations matters most. With emerging forecasts hinting at inevitable potential volatility, the stock market finds itself teetering on the brink of what could be a transformative journey. This moment in time is a clarion call for investors to reflect deeply, strategize astutely, and consider participating in the ongoing conversation. What is your perspective on the impending path for formidable market giants compared to the robust collective strength of diversified indices? And finally, if you would like to know what companies like Nvidia have been up to these past few days, go ahead and click on the next video on your screen. See you there.